I'm James Robinson, and this is my stock pick of the week. This is part 2 of my 5-part series on Intel. This time we're going to talk about the company's operations. So before we talk about Intel and their operations, one of the things I think we should talk about is what's happening with Intel and Apple and the Apple chips. So unless you've lived under a rock, if you follow technology at all, or if you have any interest in this company Intel at all, you'll recognize that Apple Computer used to buy all their chips from Intel, and now they've started the process to make all their chips themselves. So obviously this is going to have an impact on the amount of money that Apple can make, or that Intel can make selling chips, as Apple will no longer be a client. So before I did the analysis and decided to buy this stock, I tried to get a handle on exactly what that meant. So the first thing you should think about is that Apple makes roughly 20 million computers a year. Again, I'm just going to give you a ballpark for these numbers. They're close enough. You're going to see when I get to the point that they're not the end of the world kind of numbers. But Apple makes about 20 million computers a year. Let's assume that 100% of those computers are made from, are using chips that are supplied from Intel. That's actually not the case, because we know that in 2019, 100% of the chips were made from Intel. In 2020, some percentage of the chips were Mac chips that were used in the MacBook Air and the MacBook Mini and the 13-inch MacBook laptop computer. And so those things have already sort of been lost to Intel and will show up, and those losses will show up in Intel's books this year. But let's assume for the sake of analysis that we're going to lose 100% of the 20 million chips that we sold to Apple. Okay, fine. Intel seems to sell their chips at between $150 and $200 a chip. Because Apple is such a huge supplier, I would guess that Apple is getting them at some discount relative to someone else, simply because they're just a huge customer. But let's just say that's not the case. Let's say that it averaged $175 a chip. So if you take $175 a chip and you multiply that times 20 million computers that you're not going to sell, that works out to about $3.5 billion. So Intel stands to lose, and probably will lose over some period of time, a total of $3.5 billion worth of revenue. And it probably is a number less than that, because I think they're probably paying an aggregate of less than $175 a chip. But let's say that's the number. Intel has revenues of $78 billion. So when you lose $3.5 billion, it's about 4.4%. I actually think they're going to lose less than 4.4%. I think they're going to lose 3% roughly. That's kind of what I've done my internal analysis on. But in any case, it really doesn't matter to me. It's a rounding error when you consider that this stock is trading at 9 times earnings, and I think it should be trading at 12 or 15 or 18 times earnings. And so whether those 18 times earnings are based on, $78 billion worth of revenue or $75 billion worth of revenue, I don't think it matters much. I think this is a good company. It's well run. It's got lots of benefits. And I don't think the loss of a single customer, even a very large customer, but a customer that's still less than 5% of revenues, is worth downgrading this company and worth ignoring it. So as always, when I analyze a company, the first thing that I look at is gross margins. I've done a video on why I think gross margins are so important and why I think they're a great analytical tool for an investor to use, and I think it's an overlooked tool. But one of the things that's happening here is the higher your margins are, the more it is likely that you have a moat. If you have very low margins, it's because anyone can do what you can do, and you have lots of competitors, and so you're competing on price. If you have a very high margin, it means that you don't have to compete on price. You're able to compete because you have something that separates you from the competition, and sometimes there isn't a competition at all. So I like to see a moat of 40% or higher. When I see gross margins of 40% or higher. When I see gross margins above 40%, I start to get interested. Intel's gross margins have been above 60%, and they've been that way for more than 10 years. That's a very, very solid gross margins, especially for almost a $200 billion company. So the other thing is that when you look at these margins, they've been relatively flat. Oftentimes, a margin will start to erode. That means your moat is sort of getting filled in. Competitors are figuring out how to compete with you. But effectively, Intel's gross margins have been pretty flat for more than 10 years. And that tells me that their moat is pretty safe still. Even though Apple is trying to go out and create their own chips, they're such a small piece of the market, really, that it's just not the end of the world for Intel. And again, remember that we talked about in the first slide, Intel only makes 50% of its revenues from PCs. The other 50% comes from a data-centric business. The next two slides look at the company's earnings. and they look at the company's earnings per share. And I look at both. I don't think you should look at just one or the other, because oftentimes there'll be a disconnect between what's happening with earnings per share and what's happening with earnings as a result of the buying back of shares or the result of selling new shares. And so I like to look at both of them. I like to see earnings going up. Earnings is total dollars that come in. I also like to see earnings per share going up, and I like to see that happening faster than earnings are going up, because that means that we're making more money, but we're also buying back shares, and so we're dividing that money over a smaller number of shares. So I look at both, and when you look at Intel, you can see that really since 2010, so for the last 10 years, the earnings of this company have effectively, they've effectively tripled. They've effectively quadrupled when you're talking about earnings per share, but they've tripled in terms of gross earnings. It kind of goes up and then goes flat and then goes up and then goes flat. But generally speaking, it's the trend is upward. And the last couple of years, it's been pretty significantly upward, as you can see from these charts. So the earnings for Intel are something that I think you should be excited about. And I don't think these earnings reflect a company that should trade at 9 times earnings. Another thing that I look at is net earnings as a percentage of revenue. And I think that that's an important metric, because that just shows you how much every dollar that comes in flows through the bottom line. And you can see that the top 10% of companies have a net earnings flowing down to profits of about 25% ballpark. And you can see that for the last 2 years, Intel has been in the top 10% of companies. So here's a company that we're buying that's very large, it's got a very good moat, and its net earnings as a percentage of revenues in the top 10% of companies. They've grown earnings relatively consistently, and you can start to see why I'm excited about this company. You've got significant gross margins in terms of which demonstrate that they have a moat. It's just everything sort of adds up for this company to be a much stronger company than the market is giving it credit for. Another interesting sign, and I haven't done a video on this, but I'm working on it, it's in my queue, is the importance of selling and general administrative costs. One of the things that's really interesting is I look at selling general administrative as the effort you have to put into selling your product, right? If you're spending a bunch of time, energy, and money on sales, it's because you're either competing with other people or your product isn't an obvious one for someone to buy. By the same margin, if you're not spending very much on that, then there's something going on that makes the customers come to you. And that is, again, indicative of a good moat. So again, when you look at Intel, you see that for the last 2 years, they've been in the top 10% of companies in terms of selling and general administrative as a percentage of gross profit. So that's fantastic. This company, just again, is another metric, another way of looking at this and coming to the conclusion that this company seems to have a product that the public still wants. And so I love this company. The other thing I want to talk about with these next couple of slides, there are what I consider the 4 taxes. They are selling and general administrative, plants and equipment, research and development, and inventory. Those are costs that a company has to bear as part of their operations. They can't really do much about them often. And they're things which really can grind up your profits. And so they're also sometimes things that a company can do a better or worse job of managing. And so we like to keep track of those things and see how a company is doing that, because that's one of the ways we measure management is what's it doing with the things it can control. Often a company can't control the cost of goods sold, but they can control how efficient their sales process is, for example. Plants and equipment for this company are higher than I would like. They're one of the blemishes on this company. But what you have to understand about Intel is that they're making a tremendously complex process, a chip, which is made through a tremendously complex process, and it involves clean rooms and all kinds of high technology, and a fab, which is a factory for building silicone chips, can be $1 billion enterprise. And the good news is once you have that, you've got a moat that your competitors, in order to compete with you, they have to be willing to spend enough money to go and create a similar fab. So while plants and equipment is a big dollar outlay, it's also something that you're unlikely to find very many competitors that are going to go and do against you. So while I hate spending a lot of money on plants and equipment, and I give high points to companies that don't spend a lot of money on plants and equipment, I respect and understand why Intel has to do that. Nothing is ever, rosy, as they say, and there's always some blemish. There's always something that makes you concerned. And one of the things that I don't love about Intel is their inventory numbers. It looks like inventory as a percentage of revenues has gone up every year since 2014. I hate that. I wish that wasn't happening. I'd like to see that trend start to reverse. But for now, that's where we are. The same thing is true with R&D. again, when you're a company that spends $16 billion in R&D, which is what they spent last year, that creates a moat because there's so many companies that have the ability to spend anywhere near that to compete with you. But I don't like to see the number be this high. If you have to spend that much money every year just to stay competitive, that's a tough industry. That's something that is a cause for concern. And if it wasn't for the fact that I knew that those R&D dollars tend to be generating a product with a really, really high return on investment, I'd be more concerned. But I don't want you to think that I haven't looked at the inventories and that they aren't a cause for concern and that I don't feel the same way about the R&D dollars. I'm just willing to accept that, you know, every business has something about it that's not perfect, and that's what's going on with Intel. So I'm just going to talk briefly about interest payments. Intel has started to rack up debt, but I believe they've racked up debt, you know, sort of the same way that Apple did. They just have, they do a lot of business overseas, and rather than repatriating their money, Apple was borrowing money to run their operations and leaving the money overseas. And those numbers sort of were a wash. And I think that's the same case here with Intel. I mean, interest is, you know, less than 4% of operating income, so it's a non-issue completely. I just don't understand why a company who makes so much money needs to borrow money in the first place. But I recognize that they do. I also recognize that the interest income almost exactly offsets the interest expense. And so the fact they borrowed this money is really not relevant because they've got enough money in the bank that's paying enough money in interest that makes it so that there's no real financial cost to servicing their debt. So it's kind of a wash. Again, I don't like to see companies that have any debt. I really grade down on companies whose debt is increasing, and I did, in fact, with Intel, as you'll see in the finance slides in the next video. But I just don't think interest is a big problem with this company, and I don't think that the debt for this company is a problem, other than I just don't know why they're doing it. So in summary, I look for companies with a gross margin of at least 40%. This company's gross margins consistently been north of 60%, so A+ there. In the last 10 years, the company's earnings have more than tripled. That's fantastic. Again, hard to believe that a company that has done that would only be trading at 9 times earnings. On a per share basis, the income has more than tripled. The earnings have more than tripled. Net earnings as a percent of revenue is at an all-time high. So the company is becoming more and more efficient at turning dollars that come in the door to dollars that fall to the bottom line as profit. Selling and general administration, the top 10% of companies. I talked about why I think that's so important. The company's plants and equipment and R&D are higher than I typically invest in. But you got to take the good with the bad, and no company is perfect. And finally, the company has more cash than debt. Its interest income is basically equal to that of its interest expense. So it effectively has no interest expense. So when you look at the operations for Intel, if anything, I think there's a lot to be excited about. And there's nothing really feels to me to be very pessimistic about. We also talked about Apple and the effects of the Apple switching to their own internal silicon chips, and why I think that while that's a headwind, it's not a significant headwind, and it's not a reason to not buy the stock. So that's the summary, and that's the operations for Intel. Thank you very much for following.